Good morning, everybody. Thank you for joining us today for our webinar about fundraising for fintech startups. My name is Georgie Friedrichs and I work for Crowdfunding Hub. We are a think tank and policy advisor for everything in the alternative finance space. And as such, we are a partner in the FINE project, the European Fintech Investor Network and Ecosystem Project. And in lieu to this project, we are welcoming you today to our webinar. With me today, we have two very interesting speakers. We have Robbin Hoogstraaten, who is a startup specialist in the investor world. And we have Esther Baird, who is a senior business consultant of the Pinnacle growth group. Both of them are very experienced in this field, so we are very happy that they are with us today. So, after this short introduction, I will take you into our webinar. This is what our agenda will look like today. We will start with some opening remarks, which I'm doing as we speak. And then Robbin will take us into the funding types and finding of a funding strategy for fintech startups. After that, Esther will tell us more about using your networks and how you should walk the process in finding the investors. I will then shortly tell you a little bit about the FINE tools that we have developed in the projects, and then there's some time for questions and answers. We're putting a lot of it into an hour, but we think that's the best because an hour is a good attention span, and after that it gets a bit long. So that's why we're going for a high-speed approach. We have a chat, so if you have questions, please don't hesitate to use the chat to ask us questions. We would love to hear from you. Because the speaking has been disabled for the participants because the chat is easier to handle because we're quite a large group today. All right, so I will shortly tell you a little bit about the FINE project. Some of you will already know the FINE project, we hope, of course, but in case you don't and you've just joined us fresh today to the FINE initiative, we have quite an ambitious goal. Our goal is to build stronger connections between fintech networks in different countries. So we want to strengthen the network in the country, but most importantly also between the countries. Because in research it has been shown that the different networks don't really connect that much, which means that investors don't find fintech companies in other countries and vice versa. This, of course, is a pity because there's a lot of opportunities in other countries. There's some regions that are very developed and some regions that are less developed. And in this project, we're trying to connect this, and our main approach is to connect through the investors. So if we get the investors to collaborate and invest together into these startups, they can share their experience about the local market and about their home market and make it all stronger so we can really be a large European ecosystem for fintech. So that's our goal. We are trying to reach this through a number of tools. We have I'm going to tell you about that at the end of the seminar. So I'll drop that for now. Here you see the objectives that we have in the project. So we want to increase the access to capital and investments for the less connected fintech ecosystems. We want to increase the access for the investors. We also want to improve the accessibility of knowledge for all the investors in all the different countries. And we think they are actually the best parties to help each other and to educate each other. So that's why we've developed the tools as they are. And we also, very importantly, want to facilitate inclusiveness and gender equality. So we want to empower women and minority groups to join us in the fintech system, so they get the role that they deserve and that we also need to be a successful network. So that is quite ambitious, but we've been on the way for quite a while already. We've developed some tools, we've had workshops, we've had webinars, and this webinar is one of them. So that's all about the FINE project for now. I'll tell you a bit more about the tools at the end, but I think we should dive into the material that we're all here for today. So I would like to give the floor, or the mic in this case, because I mean the virtual floor, I should say, to Robbin, who will take us through the first part of our webinar. Robbin, the floor is yours.
Thank you very much, Georgie, and really happy to be here. To be well, a part of such an ambitious project as you told already, because I think it's a really well, important subject to attend the right attention to. So a little bit about myself, because then I think you also know why I'm a fan of these kinds of projects. My name is Robbin Hoogstraaten. I started roughly, let's say, 10, 12 years ago in the Netherlands with one of the first crowdfunding platforms, which was called SeedBlink. It was one of the first crowdfunding platforms in the Netherlands, and in hindsight, it turned out to be one of the first crowdfunding platforms worldwide who started the initiative with equity crowdfunding. And from that, we actually grew in mainly our local market. So our, well, let's say the Netherlands as a big crowdfunding player, but outside of the Netherlands, it was really hard to gain extra traction. And that's like Georgie said, it's just difficult to connect investors amongst different countries, but also to connect entrepreneurs amongst different countries. In the end, when we were with SeedBlink already in existence for over 10 years, we sold our company to SeedBlink, which I became a managing director of the Benelux for. SeedBlink is from originally a Romanian platform who also has a company in Bulgaria, in Greece, in Austria, and in the end also in the Netherlands by buying SeedBlink. And that's when we found out how important it is to create connections amongst European countries and to connect networks. Not only in order to connect investors, but also to help entrepreneurs grow and to help entrepreneurs to gain a larger market, let's say, share. So my experience is mainly in helping startups raising capital, mainly equity related. So I know a little bit less about debt, but I also encountered my fair share of debt funding because we funded our own company also via different ways, including debt as well. So that's enough about me. I'm here to tell you a little bit more about funding strategies and everything there is to know about it. But first, we have a little slide also announcing our second speaker. So maybe, Esther, you can already give a glimpse of who you are.
Thank you, Robbin. Yes, my name is Esther Baird. And as you can see, unfortunately, I've got over 30 years, which don't look at that one, 30 years supporting startups. Now, not always in the fintech side. I've been working on all startups from every sector. My background's accountancy, so I understand the finances and all of that stuff. I would been very much involved in the fintech corridor in Ireland, which is the one that looks at looking at the corridor between North and South of Ireland, and we're looking at those fintech companies. And I would be involved in sitting on some of those panels and looking at some of their pitches. So if the guys are, I would probably be at the other side trying to look at those potential investments and seeing if we can invest in those. I have invested some, but I would be more inclined to get others to invest. Not my scene, but I do score them, and I'm sitting on panels that would score some of those things. So I'm very familiar with that. And I would look at strategic planning and all those business planning. So that's me, and I work for Pinnacle Growth. And just I think the next slide is where these are some of the companies that we would work with in terms of Pinnacle Growth. It's a smaller business in Lisburn and County Antrim in Northern Ireland, but we have quite a number of broad spectrum of clients that we work with from all private sector, public sector, and fintech companies. So that's me, and you will hear me later on. I'll leave it back over to Robbin. Thank you, Robbin.
Thank you, Esther. So indeed, you will be back in a bit to explain a little bit more about the network part of funding. So First, I'll take the stage with a couple of things about fundraising and setting up strategies and where to think of what to do and what not to do, definitely. So I'll take you through the goal of the workshop, a little bit about the different types of funding, and then we go into what we would call the funding life cycle. And the funding life cycle is, in my opinion, an important thing to realize where you are as a startup in order to determine what you need to do in order to raise funding. Because it might be that you're already a serious scale up, that you're, let's say, in the stage of talking to venture capitalists, but it might also be that you're just starting up your fintech initiative and you just need to find the product market fit. And there's a lot of, let's say, pre-development before you get there. And for every stage, there's a different thing you need to encounter or different things you need to realize. So that's what I want to take you through. So without further ado, let's just dive into it. So why we do this, or why at least the Fine Network also helps for this, is because there are a lot of challenges for entrepreneurs. And these challenges are, well, let's say in common, mostly over all of these phases of being an entrepreneur. One of them would be choosing the right type of funding. So do you sell equity? Do you work with convertibles? Can you go for debt? Do you do it sustainably? So are you thinking about the day after today? So not only raising the funding to develop your company today, but also make it durable so that you're fundable regarding the future, that you're accessing enough funding, because you really need to make a decent plan so you're not raising constantly, but you're also having time to deploy the capital and to make sure you can grow your company, how you convince the investors, and how you choose the right partners. So I think these are all common things which startups in every stage of the way will encounter. Some of them less, some of them more, but these are the problems we at least try to pinpoint a little bit today. So I already tipped a little bit about the, let's say, funding life cycle or growth funding life cycle, and that's where we are ticking in today. And here we have an image stating a little bit about the different stages, which in this case, it's starting, like you see, from the ID stage. So having a good plan, a good business case, which you are able to develop, and then in the end, working your way all the way up until maybe even a potential IPO, so going public with the company, which is not per se for every company, but it might be a goal you have as an individual. So I'm going to take you through all of these steps and give you some tips and tricks on what to do, what don't do, what you should definitely not do. And then if there's more room for questions, of course, then just feel free to put them in the chat or at the end. So a little bit about growth funding. First, I want to make a distinction between two types of funding. And I don't know how familiar you are all with already diving into, let's say, funding strategies and everything there is to know about funding. But just a small recap is one of the first things which is important for you guys to know is that there are two different types, two main types of funding, which would be defined as debt and equity. Most of you, as being fintech startups, will be small, let's say, tech startups, which in the end will develop into scalable companies, which means that at the beginning, you don't have a lot of assets, which you can, for instance, use as securities for funding your company or something like that. So most of you will probably look into equity funding to start off with. If you're a little bit more mature and you're already having a decent cash flow, or you have some assets which you can use as securities into your fundraising strategy, then it might also be able to you might also be able to take in debt. A third form would of course be subsidies or grants, which is also something you need to look into. Definitely look into that on the regions where you are in at this point in time. Because I know, for instance, in the Netherlands, we have roughly 5,000 different grant schemes. This is only the Netherlands, which are dependent on the region you're staying in, dependent on the country, the industry, the state you are in, which is in the end also a possibility for some fintech startups, because you're just tackling, let's say, problems which are important for governments to solve. So they have some money also to spend on that. If you're thinking about debt, then make sure that the debt funding is usually giving a little bit of pressure on your growth, because it's something, let's say, that you need to pay back. Often you pay back immediately, so you need to be able to pay back these loans. And there's usually a fixed interest rate. There's a limited risk for the investors, usually. A little bit of a higher risk for you personally, because sometimes you also co-sign and you're personal liable. So that's important to realize if you go for debt. If you tap into equity, then it's usually a little bit more flexible, but it's also co-ownership. So you give out some control. And this is important to realize, because if you're starting up your fintech startup, you want to, of course, grow your startup on your own because you're the entrepreneur. But if you're selling your equity and you're involving investors into your equity, then it's important to realize that they also want to have a say in what you're going to do. So you need to have a certain commitment, and the investor needs to have a certain commitment, because it's a longer term, let's say, investment. There's no direct repayment, there are no fixed interest rates, but it's about profit sharing. So usually we're talking about higher risk investments here, but at the other hand, you're talking about potentially a higher return. So it can be a multiple of your investment if you're, let's say, investing as an investor. With equity and with debt, it's usually about these interest rates anywhere between, well, you name it, 3 to 10%, depending on what kind of alternative funding you're tapping into. So for debt, if you're thinking about debt, make sure that you know a couple of things before you reach out to investors. And one would be your debt equity ratio. So you have a good and clear understanding of how your company is currently funded, how your balance sheet looks like, and pay attention to the agreements you're signing. Because with the kind of investors which are supplying you debt, or the banks or whoever is supplying you debt, in the agreement, they usually have a couple of things which are important for you to realize, like personal liability, like securities, like repayment schemes, all kinds of things which you should definitely understand before you sign. So make sure that you take these agreements seriously. And if you're not really familiar with them, involve some experts, some specialists to help you with that. So often this is favorable for startups who are, let's say, generating already some decent cash flow, who have a more of a controlled growth, and who are, let's say, able to pay back the loan starting from day one. So most of you being early stage fintech startups, that's at least my assumption, this wouldn't be the best way of funding yet. If you would use loans, there are multiple ways to get it from. It's of course about alternative funding. So you can think about the traditional ones, which are bank loans, more difficult to get. But in the alternative world of funding, you can think about crowdfunding, you can think about factoring, microcredits, leasing, commercial credits, even angel investors are sometimes supplying out loans. So there are a lot of ways to get in loan. So before you are thinking about, let's say, debt, make sure that you know who you are approaching and if they are able to supply you with that type of debt you're searching for. I see a question coming in from Kenza. I'll quickly try to answer it already. Factoring. Factoring is a way of funding your invoices. So it's for companies who already have some, let's say, cash flow, which are sending invoices to their customers. And what you can then do is that you can sell your invoice to a factoring company. They will give you the amount of the invoice minus a little percentage, and the factoring company will collect the money at your customer. So it's actually a way of generating faster cash flow. So you don't need to wait upon, let's say, the payment terms of 30 days on an invoice, or 60 days, or whatever is on your invoice. So that's a way of funding or cash flow funding for shorter term funding strategies. If you look into probably what's most interesting for most of you is growth capital or equity. Then you need to realize that you're, of course, not, let's say, not having a short-term repayment, but you are allowing people and, let's say, individuals to also have a say in what you are doing. Because if you're selling your equity, then you're also selling a part of your control. It's important to realize how you do this. So if you're not too familiar with how your company is structured, then please do some research on it, because you can sell equity with, for instance, only profit rights, but you can also sell equity with profit rights and voting rights, which means that the people also have a certain span of control in your company. So if you talk about equity, then I usually state that there are two ways of doing this. And one is like the left side of your screen here, which states shares, or let's say straight equity, which means that if I'm raising 100K and I'm selling 10% of my company for that, I value my company at 1 million euros. So important to realize that if you are, let's say, raising equity, you're also stating a certain value of your company. So you should be able to tell to the investor and to, let's say, defend what is the value of the company. Why is this value the value which I state of my company? And why do I think this is worth it? Because that will be the discussion you will have with the investors. Apart from, let's say, some clauses which can state if they want a early repayment on dividend, or I do not want to go into too much details here because probably that will be a whole different session we can fill with that. But with equity, you are selling a part of the company, a part of the control. Like I state with the example of 100K and 10% of your equity, stating your valuation at 1 million, it might also be the case that you actually don't know what's the value of your company. Then there's some sort of a sub-way of equity which you can choose for, which is a convertible loan or convertible bond. In this case, you're first giving out a loan or a bond with a certain interest percentage. And then at a later stage in time, you can flip this loan plus interest, which was built up or accrued over time, and you can flip that into equity. And only at that point in time, you're talking about valuation to flip. This is a way of, let's say, getting in some early risk capital or growth capital without determining a valuation for your company yet, and only talking about the valuation a little bit later in time. Usually you do give a discount on your valuation if you're using convertible loans, because people invest today with a higher risk than they would get in 3 years when the convertible would potentially flip from a loan into equity. So then you state, for instance, in 3 years, my company is worth, I don't know, 2 million, 3 million, 4 million. And then they get a little discount on that valuation because they supplied the capital already in a riskier stage before. So this is the, let's say, the equity scene. I see here what scalable and rapid growth means for you. There's a question I got from Bruno. Are these ratios and assessment frameworks PE firms rely on before investing? It's a good question, Bruno. Thank you. And I would say that scalable and rapid growth means that you're not talking about a 10% growth rate month to month, but you're talking about 100% growth, 150% growth, maybe even 200% growth. So it's really, let's say, steep growth where you need to pre-finance your activities. That's rapid growth. And there's not really specific ratios or assessments PE or VCs work with. It depends on every investor themselves. They will have their own, let's say, way of thinking about it. So I hope it answers your question a little bit. You
Robbin,
want to state something, Georgie?
Yes, there's also a question of Kenza. She asks you what factoring means.
Yeah, I just explained factoring. So that's like selling your invoices. So that's the explanation I gave about you sell your invoice and then the invoice will be, let's say, prepaid by the factoring company. So that's a way of funding short-term cash flow. So let me dive in because I think we're sharp on time. So I'm rushing a little bit through this. You will get the slides. If there's more elaboration needed, then please use the questions afterwards or connect with me on LinkedIn if you want to know anything. We can always see if I can help. But a little bit about this funding life cycle I explained, because I think it's good for you to understand the stages of this funding life cycle, to think of the stage you are currently in as a startup, and to take that stage as your relevant, let's say, background in order to think about what steps to take next and what to do, what not to do. So first I want to cover the ID stage. So the ID stage, well, it already states you have a great ID and you're going to validate it and you're going to develop it. Usually you don't have any revenue yet. It's just, let's say, at the bare start of your startup or your fintech journey. So at this point in time, I advise you not to raise any funding yet. And that has just to do with the fact that you need to spend some own time and some own money, if possible, and you need to bootstrap. Because if you are bootstrapping your way through this and you're trying to be creative, then in the end, you're, let's say, proving towards the market and also to potential future investors that you're able to take some risk yourself as well. Because then as an entrepreneur, of course, an investor also wants to see that you're taking a certain risk and that you're not only taking a risk with the money from the investors. So at the ID stage, it's usually difficult to raise funding. You can actually, in the ID stage, and that's for every locale you guys are in different, but you can look into grants. So sometimes you can validate your ID by opting for a grant in a certain region. For instance, the Netherlands had quite some grants on fintech because you could think about financial inclusion, you could think about financial stability, and these are big topics which the governments like to support with supplying grants if you're able to tackle these topics. So in the ID stage, do, let's say, investigate if this is something for you as well. Then after the ID stage, we usually state what we would call the co-founder stage. So then it's becoming a little bit more serious. You're involving some other people into your company and you're trying to really validate and to get a little bit further with your, let's say, sole ID as a founder. So you're trying to test it a little bit and you're trying to find ambitious partners who are able to add value to your company next to your own value. So at this point in time, it might be interesting to take a little look at how you are distributing your equity with you and your co-founders. Are you, for instance, using a management buy-in? Because sometimes you see that somebody is really enthusiastic about your company and they want to be a co-founder together with you, but they already come from either an entrepreneurial background or they were in a corporate before, so they have some money to spend. Then you can state with them, hey, if you are joining my company and you want to be a part of the equity, bring in a certain amount of capital. And then in the end, do pay attention on how you are stating these agreements with your co-founders. So usually I'm a fan of performance-based contracts in the beginning, which means that a co-founder who's joining in later needs to commit towards certain KPIs in order to get towards the equity you promised to them, because you can only sell your equity once. So be careful. And make sure that you're doing this well informed and well, let's say, structured with the agreements there. So after the co-founder stage, we really go into, let's say, the first, well, small funding stage, which is called the family and friends stage. So family and friends, I don't know if some of you have experience with it, but family and friends stage usually means that you're involving some, let's say, more direct relations into your company. So Esther will also talk a little bit about using your own network in a bit. So that's also how you are involving, let's say, people from your more direct scenes. And here in this stage, usually we state that there's still a low growth. You don't have what we would state monthly recurring revenue or maybe no revenue at all, but you're getting towards a, well, MVP somehow. You're working towards launching the company. So in this stage, it's important to don't raise too much money, because you actually don't know what's going to happen into the near future. So if you raise too much money, there are two things. One, you become lazy because you're having money to test and you need to be creative here. And two, you might sell too much of the company already in order to raise funding in second stages. And definitely if you're a scalable fintech startup, it's important to keep your equity safe for future rounds, because you will need to raise more funding in the future. For some of them, of course, that's not the case because they're able to bootstrap their way through. We have some nice Dutch examples of companies in the fintech space like Moneybird and like Adriaan Mol with Molly, who were able to bootstrap all their way towards profitability. But we also have fintech startups like Adyen, which probably all of you know, who really took in funding early on, but took a close look on their equity. So they involved only the right people with the right amount of equity at the beginning. So don't give away too much of your shares, and maybe you can work with convertibles here or with options to not sell too much of your control yet. I see a question from Mathieu. Can you please give an example of KPIs that you have seen applied to co-founders? Yes, I can. And would depend on the kind of co-founder you're talking to. If it's a commercial co-founder, that's the easiest one, because a commercial co-founder usually needs to sell your service. So then you can come up with a KPI where you state like, hey, you need to sell an X amount of revenue in order to get towards, let's say, this amount of equity. If it's more of a operational co-founder or more of a technical co-founder, it becomes a little bit more difficult. With a technical co-founder, of course, you can set up certain deliverables like, hey, you need to bring a working platform Yes, I think I'm back again. Yeah, I think my internet dropped out for a bit or something, but I think I'm back again. So I don't know what you guys
You're
still
back.
heard. Okay, cool.
No, you're back, but we lost you about 2 minutes ago, something like that.
Okay, so did you still hear about me starting about the KPIs on the co-founders? Yeah, I think
Yes.
I talked about the operational co-founder.
We're talking about
when
a
I dropped
technical.
out.
Yeah, you were talking about a technical co-founder.
Yeah. With a technical co-founder, it's important to pay attention towards deliverables. So developing certain milestones in your, let's say, your technical development. And with an operational co-founder, it's more, well, it's less easy because it's usually about, let's say, having happy workers or having a certain amount of time spent together. But these are, let's say, things you can think of. So development milestones, commercial milestones, or partnerships, these kinds of things. So let me rush a little bit through because I also need to save some time, of course, for Esther still to have the more important part of also talking to your networks. So a little bit about the seed stage, which is the next stage. I'll come to Kenza's question in a bit, if a co-founder is really necessary. But seed stage would be the stage where you have a minimum valuable product. So you're actually, let's say, getting towards business. Your valuation is pumping up a little bit. In terms of fintech, it can even be higher than 1 million, 3.5 million. And you're getting towards, let's say, some recurring revenue. So you're having your first transactions on your platform. Everything is working. There's a more of a let's say, a good growth rate. And the funding need usually comes between 200K to 2 million. So at this point in time, you're going to talk to incubators, accelerators, family offices, strategic partners. Crowdfunding might be an interesting one, business angels, or sometimes early stage VC. VC is not too keen in the seed, pre-seed stage. If there's not a lot of revenue yet, they want to see, let's say, anywhere between 10K to 50K MRR, pre-seed VCs. But still, it's good to talk to them. In this stage, it's really important to make sure that you still own enough of your equity to come to the first really serious funding round, your Series A. Because in a Series A round, you're actually involving an investor who has a lot of, let's say, demands on how they want to be a part of your company, so a venture capital fund. And they want to have, let's say, a significant stake in your company. So in this stage, seed stage, if you're involving angels, don't sell too much. Try to avoid anti-dilution deals. So anti-dilution means that an investor is chipping in equity now, and in the next round, they don't dilute if there's a next equity round. And then it's time for company valuation. So pay attention to pre and post money company valuation. I see a question of Kenza also about how do you do an evaluation or pre-valuation. This is difficult because an evaluation is done partly upon what kind of value you built up until now. But there's also a large part of value which you are creating into the near future. So there are specialists who can help you with valuing your company. If you're really early stage, then I usually say as an investor, being an investor for over 11 years, that it's a little bit like this. We just state it's anywhere between 1 to 4 million, and we make a good negotiation. We pay attention with the market size we're tapping into, the earning potential, and then we're coming up with a number which makes sense. And use benchmarking. So try to benchmark to other deals who happened before. At this stage, it's really important also to focus on the right match. So make sure you click with your investor because it's a marriage. You're in there for a long time and you want to make sure that it's a good time together. So make sure that it's the right match with your investor. The next stage would be Series A. That's the first really, let's say, bigger stage where you're involving usually venture capital funds if you're really, let's say, a scalable company. So pre-money valuations are kicking up. So you're talking about 5 million up. There's more recurring revenue. There's a larger growth rate. And the financing need becomes bigger. So then it's either strategic. Strategic can be banks joining or these kinds of, let's say, more strategic investors or venture capital. Again here, and that's what I stress throughout every stage, be sure that you know that you don't sell too much of your equity. Start in time. These rounds, Series A rounds, usually take 6 to 9 months in order to complete, from getting the first talks into having the money on your bank account. So make sure you start in time, and also take a look at the investor's portfolio. You can, by talking to some of the companies which are a portfolio company of an investor, you can already learn if they like their investor, how they act in good times, how they act in bad times. So this helps you to also do your due diligence on the investor, because it's not only the investor who's going to do due diligence on you, you need to do it the other way around as well. So then after Series A, there's a question, what now? So your first big funding round has been done. Well, what we see usually with fintech startups is that they will still go for a Series B or a Series C. That's usually when international investors get involved. So up until Series A, you're usually talking to your local investors, and then more international investors, London-based, Paris-based VCs are joining in Series B or C rounds. And this is usually done through connections of your investors. So that's important to also involve them. You can grow organically, of course, if you're doing a great job, so you don't need any funding anymore, or you go public, an IPO. That's an option as well, of course, to not necessarily as a goal, but it can be a nice way to raise an extra amount of capital, of course, and to create an early stage exit for your first investors. Because do realize involving investors means that they want an exit also at a certain point in time. So you need to tell them and supply them the possibility to create an exit. So IPO, I usually state it's not a goal per se, it's a means to, let's say, generate exit. Well, don't think about one way of investing, because there are always multiple ways you can combine, which we would call co-investment. So we talked about debt, we talked about equity, we talked about angels, venture capital. It might be that you're involving them all into your company. So in the end, you can split up one funding round with different investors, one who takes the first leap and who's jumping in first, and then the other who wants to join. So you can usually split up your funding round, and you can co-invest with different investors to make it more bearable in terms of risk for these investors. So important to realize that. So you can take in crowd, business angels, strategic, professional, but if you're thinking about this, make sure your investors are aware of your intentions, so they also know that others are joining, because sometimes they also have their opinions here. So there's one other question I see from Bruno. Are Series D and after a red flag about a company business idea or an economic formula viability? Bruno, that's a good question, and I think it really depends on the business case. Some companies are just not built to be profitable really anytime soon, and they are, let's say, having the winner takes it all market. So then there needs to be larger funding rounds in the end to flip into profitability. So it really depends on the business case. So it shouldn't necessarily be a red flag. It can also be a strategic decision. Of course, there are also examples of companies dragging along and raising funding every time in order to survive. Then it can be a red flag. So a little bit of summary about what I told you, and then I'm giving the word to Esther, is that if you are raising throughout these stages, there are a couple of things to really pay attention to. That's, of course, one, the funding, the amount. What are you taking in? What kind of equity are you selling? How much of your equity are you selling if you're thinking about equity? Do not mistake yourself that funding can also be a marketing strategy. So it can, if you involve a certain strategic partner, there can be more to it than only funding, because these partners, these names can help you to grow. They can help you in other networks as well. Crowdfunding is a really powerful tool to also market your startup to potential customers or people who did not know about you. And in the end, and that's, I think, a nice bridge to where Esther is going to take you, you're involving people also with a lot of knowledge and network. So it's not only you anymore. There are also people who are joining you and who can help you to get introduced to any, let's say, other investors or outside of your country, these kinds of things. Then I think I have a last question, which I will answer here, and then I give the floor to you, Esther. And that's, do we have stats about the percentage startups that go to bankruptcy? I do have some stats. But let's say it depends on the scene you're tapping into. I don't have fintech stats, to be honest, so specifically fintech. But what I usually see is that from startups which are starting from the first year onwards, definitely 50% will not reach a second stage. So usually see that 50% well, ends or goes to bankruptcy in the first 2 years, first 3 years, and only, let's say, of all of the startups there, only 10 to 20% is becoming really successful. So that's also why investors are quite keen on making sure that you don't have, let's say, that they try to test your business model as soon as possible to find out if you're a winner amongst their portfolio, because they need to get some return on their investment as well. So yeah, last part, sorry, I missed this slide. Also important, of course, to think about the structuring. So I talked a little bit about the equity, and make sure that you know how you are selling your equity, what's the agreement you're signing, and so on. So that's my part. A little bit of a rush. If there are questions, I'm still there at the end. But Esther, of course, I want to leave the floor for you as well.
Thank you very much, Robin. That was absolutely brilliant. And I'm sure it's given us all an insight of how to look for investment. I'm just going to now cover a bit around if you're ready for investments, how do you get ready and who do you want to pitch it to, some tips around the pitching for that. And then again, using some networks and stuff to try and gather momentum. So the first thing, I suppose, if you're investor ready, and to ensure that you're investor ready, make sure you've got the following, I suppose to say a 2-pager, which is really to arouse the interest from potential investors. This should be concise, visually appealing if you can, a document that really shows some aspects of your business, things like company overview, a brief description of your business, what you do and why it matters. And then the sort of, I mean, I think Robin touched on it there, the market opportunity, what size and growth in the potential market that's out there and how you're going to succeed in that market. What makes you basically your USP, what makes you set out apart from your competitors. And again, some key financial highlights around revenue projections, your key milestones and profitability targets if you have. And then finally, a little bit of a call to action saying that for clear next steps for the investor to say, speak to me or get in touch and you can learn more. So it's a very brief document, but a 2-pager, but it's enough to arouse interest around those investors and what they're going to do. And then the next thing is, like they call it, once they've gone aroused and they sort of have a bit of an interest in your business, then we talk about an investor deck, which is a pitch deck, for want of a better word. It's how you pitch your business. And the objective is really to share the investor and show that a more detailed sort of presentation on that walks through what investors, your strategy, your vision for your business and what you really want to do. So basically the contents would be something like the problem that exists and how you're going to solve that problem. What market are you going to do and how you're going to solve it and why. Basically why you're going to do it is very important. You know, it's around, there's a problem, I'm going to solve it, but why am I going to solve it? Because it's going to make a difference. And that's basically what investors want to see. They want to see something that's unique and that's going to make a difference. They demonstrate how the solution is going to work. Again, I talked about the market opportunity out there, deep dive into where the actual market size is, do a wee bit of research on that size, where you fit within that market. Are you small? Are you large? Are you going to be top of the scale in the market? And again, explain your business model and how you're going to make money. There's no point in saying the investor has, as Robin has said, they're not going to go and invest something if they're not going to have something that's profitable. So how are you going to make money? And then traction, showcase the key milestones, your customer base, and potential major partnerships that you're going to be looking at. I mean, Robin talked about those partnerships. Who are those partnerships? How are they going to look at? And again, this one might need a bit more financial projections. You might need to do 3 to 5 year projections and some of those unit economics that go behind that and the key metrics that would be behind of those as well. And then most importantly, your funding ask. What do you want? And how much are you raising? And what do you want to use it for? And the third thing then is your information memorandum. And that's basically when you get to the third stage. And this is now finalizing that document. The investor's interested. They're looking at a detailed more document and it's more comprehensive breakdown of the company. Things like again, we talked about the company overview, your background, history. And honestly, it's very, very important to write down your mission. If you've got a social mission, a social purpose, that sometimes sells a lot of stuff to investors. They like to see that. They see that that's something it might gel with them. There might be an investor that has the same social purpose as you. So if that's very important, get it down on your paper and let them see that that's important to you. Look at your competitive landscape. Who are your competitors, your target audience? And again, this time you're going to have a bit more financials not just 3 to 5 year projections. You're probably going to have to look at some historical stuff, and it's going to have to look at detailed balance sheets, profit and loss accounts, and cash flow statements. And again, risks. You need to show your potential risks. How are you going to plan to mitigate against those risks? Well, you've got risks, but yes, I know there's risks, but I'm going to mitigate those risks. And again, most importantly, your exit strategy. Investors, you know, they want to see the return on investment. What is your exit strategy? How are they going to, is it IPOs, acquisitions, etc., etc.? And then terms of the investment. What terms are they going to have? I mean, Robbin talked around those terms, around, you know, how they're going to, the breakdown of the term, is equity, percentage of the equity against loans, validation, etc., etc., etc. Each of those documents builds up, the previous one builds up for the potential investors for the next stage. So to get ready, before we turn to the investors, then what do we want to do? Well, we want to validate your idea first, ensure that the product or the service that you're providing solves a real problem to the target audience. Gather as much market feedback as you can and test the concept to potential customers. Demonstrate that there's traction and that the product market fits and will be attractive to the investor. The more it fits in that market, the more it's attractive to the investor. You need to build a very strong business plan. And that means developing a clear, detailed business plan that outlines your business model, your market analysis, competition, and then financial projections attached to that. This shows investors that you have a clear roadmap for the growth that you're going to go for. You need to understand the financials, folks. I suppose that's the accountancy in me, the accountant coming out of me. But you need to be prepared to explain and what the numbers are. You just can't make up numbers. You've got to understand them, you've got to manage them, and you've got to understand and know where the financial metrics come from. That includes your cash flows, your profit margins, your customer acquisition costs, all of those things you need to understand, because they're going to ask questions around those whenever you're pitching. You need to develop a scalable growth strategy. And what does that mean? They're looking for businesses that have potential for significant growth. They make sure you have a strategy in place to scale your business, whether it's through expanding new markets, product lines, or increased production. It just needs to have something that's scalable. It needs to be seen that it's going to go from here to here and not from here to here. Investors are not going to invest in anything that's not scalable. Assembling a strong team. Obviously, investors don't just invest in the product or the service. They're going to invest in the people that are behind that. So you've got to have a strong team behind you, a capable, well-rounded team that can execute the business plan and adapt to any challenges that you have. If you're confident and you have a very confident team, then you'll find investors will be more willing to invest within your company. Secure is early stage funding, and I know Robbin touched on this a little bit. Before approaching any potential investors, it's important that you actually look at other sources of funding beforehand, sources like friends and family and your crowdfunding. This capital can sort of also build momentum and prove that there's actually viability in the business before they even try to invest in it. So it's very important that you look at other sources of funding before you actually go to large scale venture capitalists or things like that. And very important, guys, if you've got any sort of, to ensure investors will always look at your intellectual property. If it's applicable to you, you need to protect it, whether through trademarks, patents, or copyrights. They want to know that their innovation that they're going to invest in, that the competitors cannot steal it. So you need to make sure that you've actually secured that in some way or other. And prepare, and I know Robbin again touched on due diligence. You have to do due diligence as well, as Robbin says, but there's without a doubt investors will do due diligence in your business. So you need to be so thoroughly vet they're going to vet this business before you even begin to get investment. So make sure you have all the legal stuff done, your financial records stack up, all your contracts are in place, and there's no hidden stuff that's going to come back, because that will be the thing that will bite you, and it'll not help the investor in any way. So so the next thing then is, any investment, you're going to have a business plan. Now, business plans, when everybody says business plans, excuse me, you're going to find that people think it's going to be this long-winded piece of, that sort of sits in the corner and it's only used once. This is your business plan, and this is how you sell your business, and this is how you're going to sell your business to any investor. They're going to need something on paper. And again, even investment in loans, if you're going to go to the bank's going to need something as well. So it's not just for these equity investors, it is a business plan. And it's going to, basically the business plan is contents of a business plan, and they're normally all similar, and the summary will be an executive summary, and in fairness, the summary is usually done at the end. It's a summary of what you've just written. So that just covers everything that I'm going to touch on now. And basically, the activities of the company. What is the activities of the company? The description, the purpose, overview of what your business is, and discuss the industry, the business structure, the problem that your business is going to solve, and what makes you unique. What is your fintech that's going to be unique to other businesses? And a tip here, please include business history. If it's applicable and your vision for the future, it's very, very important that you look at your history, where you've come from and where you've been and where you are now. That actually helps show a picture of where you are. Let's look at your legal structure. Who are you? What legal structure do you have? Limited company, you could be a sole trader or whatever. It's all around that legal structure. Where are you in your legal structure? Make sure that that's tight and that everybody knows who owns the business and where who's the shareholders, who's the owners, and etc. etc. And again, market research. Go out and do some market research. Look at your industry trends, your demographics, your customer needs, and look at your competitor analysis. Use all that data as research to back up the market claims that you're saying in your report. Where am I? This is who I are. This is where we are, and this is what we're going to do. And again, organization management, employees, who's in the business, what's the structure. It's very important that they understand the structure of the business, who runs the business, who's the next level, who are the team, very strong team. That also helps sell the business. And again, just structure it. Important to have your historical, when it comes to finance. The finances is the most important part. You need to look at your historical finances. You need to look at where your finances are now. And it's about, can you show 3 to 5 year projections? It's very, very important. Those projections are detailed. They have your profit and loss account, your cash flow, your balance sheet. Investors want to see future. They want to see that the business is going to be sustainable. There's no point in investing in something that ain't going to be sustainable going forward. You want to have a look at your market and sales strategy, lay out your plan on how you're going to sell to the customers. Who are your customers? Where are your customers? What's your sales tactics, distribution channels? How are you going to promote that? And all of those things. Just detail as much as you can within that, in as much as you can. And again, for your financial projections, just show that growth strategy. Show the what if scenarios. What if 10% falls? What if 15% falls? You've got to do your sensitivity analysis to prove that if the worst case scenario happens, it still exists. We're still sustainable. And investors like to see the what ifs and the sensitivity analysis. Just proves that you've seen every single angle and you're prepared to look at all those angles. And again, you can add things in your appendices. You can add things in, like you can add your CVs in, you can add stuff in your appendices just to strengthen up your business plan going forward. But it's very, very important when you're in the business plan that you keep it concise, avoid jargon, and make sure it's very, very clearly understood. Research thoroughly, make sure that those research statistics all back up. You're not putting something in there that you can't back up and you haven't researched. And it strengthens your credibility of that business plan if they can see that you've researched that. Focus on your strategy. Show how your business is implement and execute your business vision. How am I going? My vision and my mission is this, and this is how I'm going to get there. Or this is how we propose to get there. And then, importantly, folks, people don't do this, but you've got to update that regularly. Something can happen tomorrow, and that can just change your whole plan. So you've got to really, really, really update that and change it as your business grows. So does your business plan grow. And it's very, very important that you understand that. And it's a live document. It's not something that is thrown in the corner and gathers dust. It needs to be live and it needs to be updated on a regular basis. So we touched on this, and this is something that that was alluded to in using your networks. Like anybody, I suppose you need to be well networked. I suppose sometimes people love it and some people loathe it. I suppose I'm very much, I like networks. I love it. I think you build up your networks is very, very important. And it also helps to build up that credibility of who you are and who your business is. And the more people that can tell the business to and talk to around your business within reason, within your IP rights, but you can obviously leverage those to help you. So existing networks, like this, you're in the FINE network, use those to reach out to your friends, your family, your cousins, your colleagues, your business acquaintances, just any investors just contact them. Sometimes you can be as bold as getting on a phone and just asking questions, and just use all those people that you know and contact as many as you can. And again, use warm introductions. If you've got if somebody has referred, or trusted individuals referred, increase the likelihood, that could increase the likelihood of somebody investing in the future. If you've got somebody who's going to introduce you to them, use that warm introduction as a way of getting sometimes alumni and professional networks from previous universities or whatever you've been in, or use them. They've sometimes got vested interests in investing in businesses as well. So it's important to go back to those kind of guys. And again, use joint fintech groups like this. This is a really good source of use of networks. These are sort of things that you want to get involved in. There's like-minded people that are doing the same thing. They understand where you are. They know the pain points. Get talking to them. Sometimes it's just around finding out those individuals. You're not the only one that's going through the pain point. Sometimes they can tell you how they got through it. So it's very important that you can listen to that. So business associates, go to pitch events. There could be just as somebody that's sitting in the background watching how someone else does it, so that you can see how someone else, when you're ready to do your pitching. Collaborate with other entrepreneurs. Again, that's very important to get shared into other investor networks. They always can say trust their judgment. They collaborate with them might mean, if you might even want to collaborate with them, it means two people. Sometimes two heads are better than one. But again, as Robbin has alluded to, that can sometimes dissolve some of the shares that you might have to share. You might have to end up going jointly, and that can dissolve some of your shares. So you just need to be very careful when you're collaborating with somebody. What are you collaborating with? Make sure there's a contract, that you know everybody knows what they're doing, so that you're not getting stung, really, for want of a better word. So again, you can use advisory boards, etc., etc. And again, it's important you can actually you can leverage with advisors and lawyers and accountants. Again, I'm an accountant, please don't shoot the messenger. We do have a purpose, and sometimes lawyers and accountants are those guys that you can sign boards. And sometimes, again, if it's a bit of a fintech business, they may want to actually invest in it themselves. A lot of fintechs businesses actually help support those type of industries, like advisors and lawyers and accountants, and it makes their life easier. So they might see that there's a good chance of investing in that type of a product or service. So talk to them, leverage them, and see if they can give you some guidance around that as well. And again, collaborate. You can actually look at innovation hubs, professional networks, legal and financial firms, etc., etc. And again, attending investor conferences. I know in Ireland we have what's called a seed corn competition, and that seed corn competition is for those guys. It's not just in the fintech space, but those guys that are looking at VC capital. We have a big investor conference every year in Ireland, and that attracts all of those a lot of VCs come. And if there's something like that within your area, go, because that's where all the investors are going to be, and that's where you want to be too. So you want to be in the room, you want to see what everybody's looking at, and you want to be in that room. And just even if you're not selling, sometimes the information that you can have is phenomenal. You can take it away and learn from. But also, it's very important then you can collaborate with universities and research institutes. They quite often have, tech transfer offices, and most of them offices would have innovation and technology research departments that are looking to commercialize products or services, and they actually would sometimes invest within that space. They also have part of their remit would be to invest in businesses, so it's important to get them involved as well. And if you're working with those guys, they might have an angel group of consortia that might invest in your business. So get them and get them involved in it at the early stages. And again, use referrals strategically. If you've already have an investor, ask them to introduce you to other investors. Most investors heavily rely on their own networks, so it's important that you can actually get them to strategically involve you in other things as well. And honestly, I can't emphasize enough, if you've got a mentor or coaches, those business mentors or coaches are valuable when you're starting at an early stage business startup. They can give you the corridor into all sorts of VCs and angel investors. And sometimes some of these mentors and coaches are, as Robbin says, in the area that you're living in, there's lots of grant funding, and there's a lot of with the grant component comes a mentor and a coach, and those guys are really valuable to you when you're trying to invest in that. So I know there's a lot of questions. Can I just come back to the questions? We'll come back to those questions at the end, because it's gonna.
Yeah, Esther.
Okay.
Yeah, Esther. I think we're. I mean, you're so motivated. It's amazing, and you have so much to share with us.
Yeah, sorry.
But we are getting messages.
Sorry, I'll just let's cut. I'll cut to the pitching. I think we need to look at this one, because if we're going to pitch, I think it's really good to get into the pitching. But okay, let's go to the pitch, and then I think we're running out of time. But I suppose for me, if you're going to pitch, I've been at the other side. And if you're pitching to me, these are some of the tips that I'm going to give you around pitching for you in front of investors. If you can use a video and paint the picture, it's really, really, really useful. It really, really, really helps paint that picture in so many ways. But you need to research that, and you need to make sure that you start off with that hook. That hook, the video will be really, really well played video. So you start with a hook, grab their attention early. Begin with a compelling story, a shocking statistic sometimes helps. This is the statistic, and then obviously that's the thought-provoking question, and then how you're going to engage your audience emotionally and mentally from the start. But be clear and concise in the first minute. Make sure that investors know exactly who you are, what you're doing, and what your worth is, and what way you're worth investing in. Communicate your vision very clearly. Paint the big picture. Explain your vision for the future, why your solutions is important in the long term. Investors want to understand just what you're doing, not just what you're doing, but why you're doing it. Why, and that's what I'm saying about at the start. If you can grab their attention early, this is the problem, and I'm going to solve that problem in the solution. Tell your story, craft your pitch, use examples of real life examples, focus on the business case, be data driven. Show you financial projections, know as I said before, know those finances inside out, folks, because they are going to ask those finance questions, and present and be confident and be passionate, but be grounded. Passionate but grounded. Don't let the passion take over from the actual fact of what you're trying to sell, and avoid jargon. Just simple language as much as you can.
All right.
Okay. And
wonderful.
Use visuals.
I think
it's important that you use the visuals, and the visuals are very, very important. Sorry, we're running out of time. I could go on all day around this.
I know, but I have to. I think we'll send the slides along as well. And Esther, if I'm pitching, I'm hiring you because you're perfect. And you're
can I just
enthusiastic.
Georgie, I think it's important. I'll just do 1 minute on.
I think because I just want
for fintech, because I think the guys. I think it's important that they look. Those are. I mean, I'm not going to go down them. That slide there basically says if you're going to invest, it doesn't even have to be fintech, but a good space. They have to have all of those things. They have to have market growth potential. It has to be innovative. It has to have a strong technology backbone. It has to have regulatory compliance with regulations. It has to be scalable, and it has to have a really good revenue model, good strategic partnerships, customer-centric approach, resilient to the market volatility, and then strong leadership and vision with an experienced team. And I think, unfortunately, I didn't get a chance to talk around those, but that, to me, is one of the key things for anybody investing. It has to have all of those things, or most of those things, to make it important for somebody to invest in. So sorry again. Yes, the slides are going to be shared, but if there are any questions, I'm happy to take them on LinkedIn or if we can.
Yeah, thank you so much, Esther. I just wanted to, Esther is part of our fintech network, and I think, and so is Robbin, and I think it shows what a powerful network it is. What we're trying to do in the network, I will just tell you shortly. We're trying to build the community, so we have a matchmaking network. It's a dynamic hub. It works through Slack and through other tools. Please join us on the Slack channel and join our matching events, because this is where we can actually connect you to investors and to other investors and fintechs in other countries. We also have a fine ambassador network, which is composed of people with a lot of experience. They can provide key insights and help you. So that's also, I think, very useful for all of you. We have the Fine Investor Academy. The webinar we have here is part of this academy. We also have an e-learning for investors and we will have material on fintech investment. So please come and check out our Investor Academy. It will be active from the end of November, so then you can find all material. You will also find these presentations there, for example. And we also have an ecosystem map and an investor map. In the ecosystem map, you can find specifics of countries, which will help you if you are considering investing in this country. And in the investor map, you will find players in the various European countries that you can go invest in. Because one of the things that we're learning in the fintech network is that co-investing with someone who has the local knowledge can also be really useful. We've run out of time for the questions, unfortunately. Luckily, Robbin has answered a lot of questions on the chat. Please, if you have remaining questions, join our Slack channel, the Fintech Defined Slack channel, and all questions can be answered there. And you can, of course, also approach us directly on LinkedIn if you want, or in any other way. We would like to thank everybody for joining us. Maria has just put on the chat the investor map, the ecosystem map. So that will really help. And Gisela has just put on the link to the Slack channel. The Slack channel is meant to be a live forum. So if you join us there, all questions, we can talk about this there. So thank you very, very much. Thank you, Esther. Thank you, Robbin. I'm really glad you joined us and shared your knowledge with us. I don't have a fintech idea, but otherwise I would start a fintech company myself now, I think, because it looks really great. But I think it's a lot of work to get your investors on board, which you can see in this presentation. So it is really key to do this very carefully, because as they say, you can only meet someone for the first time once, and they will not come back if you haven't done the first time properly. So prepare, prepare, prepare. Thank you very much, everybody. And we hope to see you again soon in one of our workshops or webinars. Right. Bye.
Thank you. Bye.
Bye-bye. Thanks very much. Right, Robbin. See ya.
Bye.